Hey everyone, welcome back to Corporate Decoder, where we unlock the secrets of the business world. Today we're diving into a filing from Main Street Capital Corporation, and let's just say they've been busy raising some serious cash. That's right, we're talking about a big debt deal that could reshape how they fund their future operations. So what's the big news here? Main Street Capital, a company that invests in other businesses, has just issued a significant amount of new debt. Specifically, they've sold $350 million worth of notes that mature in 2028. These are essentially loans that Main Street has to pay back with interest. Now, this isn't just any loan. Main Street has entered into an underwriting agreement with JP Morgan Securities LLC, acting as the main go-between for this massive offering. They've basically said, here's our deal, come sell these notes for us. And JP Morgan has gone out to investors and found buyers. Let's talk about the details of these notes. They're not cheap to borrow. These guys, they're paying a 540% interest rate on this money. And they've committed to paying this interest twice a year, once on February 15th and again on August 15th. The very first interest payment is set for February 15th of 2026. So they've got a little bit of breathing room before that first payment comes due. This new debt is all laid out in a document called the 8th Supplemental Indenture, which essentially adds to an older master agreement called the base indenture. It's like adding a new chapter to an existing book, making sure all the rules and terms for this new loan are clearly defined and agreed upon by everyone involved, including the trustee, the Bank of New York Mellon Trust Company NA, who oversees the proper handling of these debt agreements. The clock is ticking. These notes are due on August 15, 2028. But here's a potentially interesting point. Main Street has the option to pay these off early before that date if they choose to. This gives them flexibility if they find cheaper ways to borrow money later on, or if they just want to reduce their overall debt load. Now, it's important to understand what you're getting when you buy these notes. They are direct unsecured obligations, meaning Main Street is directly responsible for paying them back, but they aren't backed by any specific assets like property or equipment. Think of it as a promise rather than a mortgage on a building. This also means they're ranked equally with other unsecured debts Main Street might have, but they are effectively behind any secured debt. That means if things go really south, the people Main Street owes money to who have collateral get paid before these notey holders. And there's another layer of subordination. Here's the kicker. These notes are also structurally subordinated to the debt and other obligations of any of Main Street's subsidiaries. This means that money owed by the younger companies under Main Street's umbrella gets paid before the money owed by Main Street itself to these notey holders. It's a layered approach to debt, and it's crucial for investors to understand where they stand in that pecking order. Main Street has the right to redeem these notes before maturity, but there's a specific condition. They can do this at any time before July 15, 2028, which is just 1 month before the official maturity date. The price they'll pay to redeem them is a bit complex. It's either the present value of the remaining payments at a certain interest rate determined by treasury rates plus a bit extra, or simply 100% of the principal amount, whichever is higher. This ensures they're not getting an unfair deal by calling back the debt too early. After that specific date, July 15, 2028, Main Street can also redeem the notes at a simpler price, 100% of the principal amount plus any interest that's already built up. So they have a window of flexibility here to manage their debt costs. There's also a clause for a change of control repurchase event if something big happens. For instance, if Main Street gets bought out or there's a major shift in its management, the people who hold these notes get a special option. They can choose to sell their notes back to Main Street for full price plus any accrued interest. This is a protection for investors if a major change occurs that might otherwise put their investment at risk. The agreement also includes important promises or covenants. Main Street has to keep up its asset coverage according to specific rules from the Investment Company Act of 1940. Even if it's not directly subject to them, that's a big deal because it means they're committing to maintaining a certain level of financial health and protection for their investors. This is a pretty standard but vital promise for companies in this line of business. The entire deal was put together using a shelf registration statement on Form N2 filed earlier with the SEC. This is like having a pre-approved plan to sell securities, allowing them to quickly issue new debt when conditions are favorable. They used a preliminary prospectus supplement and a final prospectus supplement both dated August 13, 2025, to provide all the necessary details to potential investors about this specific offering. So how much cash did Main Street actually walk away with? After paying for all the fees and expenses associated with the underwriting and offering, they received approximately $347.7 million face value of the notes. Because of the costs involved in selling them, a common practice in the financial world. And what's the plan for all this new money? They're primarily going to use it to pay down existing debt, including money they owe on their credit facilities. This is a smart move. It helps to clean up their balance sheet, manage their interest expenses, and potentially improve their credit rating by reducing their overall leverage. For those who want to dig even deeper, the full details of the underwriting agreement, which lays out the terms between Main Street and JP Morgan, is filed as Exhibit 4.1 and 422. These filings provide exhaustive information for anyone who needs it, a Maintal indenture, and the actual form of the notes as Exhibits 4.1 and 4.2. These findings provide exhaustive information for anyone who needs it. And finally, the report is signed off by Jason B. Beauvais, General Counsel of Main Street Capital Corporation, on August 15, 2025. This confirms the accuracy and completeness of the information presented in this filing. Now let's put on our investor hats and analyze what this all means. Main Street Capital is essentially refinancing a portion of its debt. And issuing new long-term debt, this move signals a few things. Firstly, it suggests they believe current borrowing costs are attractive enough to lock in for the next few years at a 5.40% rate, which isn't terrible, though not the lowest we've seen recently. Their strategy to use the proceeds to pay down existing debt shows financial discipline. They're likely optimizing their cost of capital. If they were paying higher interest on older debt, this move makes perfect sense. It's like consolidating your credit card debt to get a lower monthly payment. However, it's crucial to remember these notes are unsecured and structurally subordinated. This means that in a worst case scenario, bondholders are not at the top of the repayment list. That's a risk factor investors should always consider. It's essentially a bet on Main Street's ability to manage its overall obligations and its subsidiaries' finances effectively. The inclusion of covenants related to asset coverage and financial reporting under the Investment Company Act of 1940 is a positive sign. It shows they are committed to maintaining a certain level of financial transparency and investor protection, which is good for confidence in the long run. Looking at the broader picture, Main Street Capital operates in a dynamic environment where interest rates and economic conditions can shift rapidly. Issuing long-term debt now locks in their borrowing costs for a significant period, providing some insulation against future rate hikes. But it also means they're committed to these payments for the foreseeable future. In conclusion, Main Street Capital Corporation is actively managing its capital structure by issuing new debt and using it to improve its financial health. This is a calculated move to secure funding at a specific rate and strengthen its balance sheet while still offering investors a decent yield. The key takeaway is their proactive approach to debt management, and their commitment to financial covenants are positive signs for the company's stability. Alright, that's our breakdown of Main Street Capital's latest filing. What's your take on these debt dealings and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.